Thank you very much, Neil. Thank you all for coming out. I have a lot of thank yous to say. I won't thank everybody. I've got a lot of friends here, and I'm really pleased to have them join us, except for Paul. No, I'm very happy you're here. I'm a big fan of Paul's as well. All the guys in the back row or next to back row, you should meet all of them because they're my friends and they're awesome. Special thanks certainly to Neil because Neil has always made me feel very welcome in New Albany and had the door open at New Albany Innovation and Tiger Talks, and he's a terrific guy, and it's a treat to be here. I also want to thank the Riley and the Brick House Blue team for helping out on the AV, because if there are problems tonight, it's not their fault, or today, it's not their fault. My presentation skills are pretty good, maybe kind of A- B+. We'll see if I can hit the A+ or the A- side. I'll be very happy. But Riley and the team have been great. And I just want to thank all of you for coming out and taking a chance on what sounds like a kind of a quirky topic for a talk. It is a little bit of a quirky topic, but I think there's stuff that will be interesting to you, and hopefully there will be some tidbits in here that will be useful to you and can be the font for future conversations. I'm very happy well, I'm pointing at a screen that's not on. Is that my fault?
I can get some help.
Yeah.
I've got two things to work on.
Okay. No, well, I can see it here, and it's fully lit up on my laptop. Let's see. Let's give it a minute. I will say what I was going to say, and hopefully it'll come up while I'm saying it. I have both my LinkedIn and my Instagram up there. I'm very happy to connect with people. Very interested to hear sort of what folks are doing in town. My Instagram is actually sort of more about my third side hustle, basically, or fourth side hustle, maybe, which is I'm a bar trivia host in the Boston area, and there's a lot of kind of silly stuff about trivia and about hosting trivia events and antics of the people at my trivia events. So if that appeals to you, please follow my Instagram. I'm going to talk a little bit of actually, let me give you a quick disclaimer, which is kind of housekeeping for me. I am affiliated with both a asset manager that is a regulated investment advisor, and I'm affiliated with a broker-dealer that is regulated by FINRA, which is the organization that regulates broker-dealers. And and everything I say is just going to be purely my own content. It has nothing to do with the view of either the asset manager or the broker-dealer I'm affiliated with. So please don't sue them. Sue me. Just to tell you a little bit more about myself, just partly to be polite, but I think it's actually relevant to the talk. I am a Columbus native. I grew up in Clintonville, went to the Columbus Public Schools. I would say the place that I actually live now is Finance City, which is the topic of the conversation today. And I'll get into a little more detail on that momentarily. In terms of the actual chronology, geographically, I was in Columbus. I moved to Massachusetts to go to college and to go to grad school in the Boston area. Lived in New York to work on Wall Street for a couple different firms. Lived in London for a few years, and then basically came back to settle in Boston. I still come back to Columbus quite a bit, and part of what I do, what are we doing wrong here, Riley? What did I do?
Nothing, you did nothing.
Oh, okay.
I'm just gonna reset.
Oh, okay. I come back to Columbus quite often because I've got a lot of friends, and I enjoy being here. My blood pressure drops 10 points every time the plane touches down at Port Columbus. It's not Port Columbus anymore, it's John Glenn, sorry, showing my age. And I have a few business engagements. I am an investor in a few startups that are based in Columbus, and I'm working with a few different organizations, both on the investing side and on the entrepreneurial capital raising side. So it's nice to have a reason to come back. A couple in Cincinnati as well, going to Cincinnati on Monday. I've sort of worked that out so I can kind of get some hanging out with friends, going out to the old places on evenings, and have a few business meetings while I'm in Columbus, and that's what I'm doing this time as well. But having had the career that I had, I would say one of the things that I've realized about myself is that I have really become financialized. I have begun to look at the world through a financial lens. There are attributes that everybody's involved in finance one way or another, and everybody has a different perspective. Some people need money, some people want to invest money, some people have specific needs in terms of their questions about finance or the institutions they work with. Some people, getting close yet?
We're loaded.
Yeah, okay. Was that it? So anyway, I have become financialized, and I'll talk a little bit later about some of the ways that I see the world because I've just been in this world for so long. But at the same time, and maybe this is just my perspective, and maybe it's just in my own head, but I think the world has become more financialized. The financial markets have become much more important. Financial thinking has become more predominant. There's so much more financial media in recent years than there was when I was a kid or when I was a young adult. And I think that's affected the way people operate. And it's actually infiltrated areas that were not previously considered financial. Financial, the classic example, which I'll cite a little bit later, and the one people always talk about is Moneyball. Moneyball is a book by Michael Lewis, whose first big book was about Wall Street. It was Liar's Poker, when he worked on the trading floor of Salomon Brothers, back when there was a Salomon Brothers, and was able to observe the way people thought about new products and the way people analyze problems. And he realized that exactly what was happening when he was a young man at Salomon Brothers was happening in Major League Baseball in the late 90s and early 2000s. And he wrote a fantastic book about that, and he will tell you that that was sort of the light bulb moment for him, that there was something happening here, was financial thinking was basically infiltrating something that everybody thought of just as the national pastime and just kind of a fun community event. But there was some very deep analytical, often mathematical thinking involved in how to run a baseball team. Still working? Yeah, no, it's totally fine. So that's important. And as I was getting involved in finance and then also getting involved in the startup world, I heard over and over and over again, people would describe their business plan as, we're going to moneyball this industry. Which basically means taking this kind of financial thinking and implement it in whatever the activity might be. And at the end of the talk, I'm going to talk about a couple examples of that, which I think are especially interesting and possibly surprising. I have a son who is a cartoonist and graphic artist and YouTuber, and I also have access to AI. And as a result of that, we decided let's kind of put an image together of what Finance City might look like. And so this is in some ways kind of an image of what the inside of my head looks like. So you can give that some thought. So basically, so this is sort of the center of town. This is the big skyscraper that has the big companies in it, that has maybe a big logo sort of indicating the city that you're in. This is the Finance City logo. So this is the center of the city, like any other big city. This is the exchange area. This is where stocks get traded and bonds get traded. This is where deals get made, financial deals get made. And it's very active and it's very busy, and there's ticker tapes and there's prices flashing on screens. And then there's sort of the lifestyle area. This is where the cool young yuppies, the people that are sort of making the big bucks trading stuff, trading crypto, trading bonds, hang out at night and kibitz and meet other people that might want to do what they do and sort of spend their time with them, and they think they're all cooler than the rest of us. So there's that. There is sort of a cultural or literary aspect to Finance City as well. I already mentioned Liar's Poker's great nonfiction book about Wall Street back from the 80s and 90s. The Wolf of Wall Street is a well-known film. So there's a lot of movies and TVs that are made around finance. There's Billions, there's Industry on HBO, which is probably the most accurate depiction of a trading floor. There's this really funny, interesting book about crypto called Number Go Up, which I recommend. So that's where the books are about finance, and the Finance City bookstores look like. This is where the mad scientists are. This is where the computers start doing their calculations and their algorithms and running their AI routines, and in some cases, the finance world does touch life sciences. So there's laboratories in there. There's people with new molecules and new compounds to develop that are trying to get financed, and sort of they're thinking about how do we go to the guys in the ties and in the tall buildings to raise money. So that's sort of the nerdier part. Everything's a little bit nerdy about Finance City, but that's the most nerdy part. This is the museum. This is the historical perspective. These are the things that happened over the last several centuries that affected our world. On the far right is the group of gentlemen in the southern tip of Manhattan who entered into the Buttonwood Agreement, which launched the New York Stock Exchange. So that's a painting of that activity. You can't see that very well. Too Big to Fail is not that far ago in history. That's just the book about the big financial crisis, but it's certainly a historical event. And then on the left is J.P. Morgan, the imposing banker who basically bullied the American economy into the 20th century when he was active. There's a weird mystical element of finance, I think. Some people think there's strange spirits sort of floating around and guiding people in different ways, and so this is sort of in a very kind of cryptic way depicting that. What's that? I didn't hear what you said.
You mean there's not?
Oh, oh, exactly, yeah. There may be. It hasn't gifted me with anything yet. And then Finance City doesn't actually have a sports team like other cities, but a lot of the citizens of Finance City own sports teams. So far right-hand side, that's the Cleveland Cavaliers. Dan Gilbert, right here in Ohio, owns that team. In Boston, John Henry owns the Boston Red Sox and the Liverpool Football Club in the English Premier League. And then on the left side, there are a couple guys. One of them is David Blitzer, who worked at Blackstone Partners, and another guy from Apollo, who I can't remember. But they formed a group that owns Philadelphia 76ers, the Washington Commanders, and the New Jersey Devils. So sports are something that's interesting to finance people, and again, maybe it's that Moneyball thing. Right, but again, I would tell you that I feel like, actually one more quick thing. This is sort of an interesting demographic point. These are graphs basically of the share of the American workforce, the U.S. workforce, that is represented by different industries. So the blue line, which starts way up high on the left, is manufacturing, and the line starts a little bit over 30%. 30% of the U.S. labor force in 1950, that's the far left point, was in manufacturing, and it's declined to today, to around 2020, to less than 10%. So the share of the workforce in manufacturing has declined rapidly over the past 70 years. Similarly, agriculture was a little bit more than 10%. Even in the 50s, the agricultural representation in the workforce was relatively small, but it fell very rapidly even after that, and now it's probably 2%, 1 or 2% of the workforce is in agriculture. The orange line at the bottom, it doesn't go as high as the manufacturing line at its peak, but it's a very rapid, on a percentage basis, it's a huge increase. In the 50s, probably only 2% of the workforce was in what's called FIRE, financial institutions and real estate. And as of 2020, it's right below 10%. So it's increased 4 or 5-fold in terms of a percentage of the workforce. So again, that's sort of the financialization of the overall economy. It's not just me going to Wall Street and getting financialized. I know stuff's happening around me as well. All right, so again, as I say, this has sort of affected my way of thinking. It's changed my mind, and this is not uncommon. People have their professions affecting how they look at things all the time. Lawyers think about things from a legal perspective. Accountants think about accounting. Rob Riggle, in case you're not familiar with him, is a comic actor and comedian. He's often on the on the Fox NFL Sunday broadcast doing sort of funny bits about football. And he, for 22 years, was a Marine. And he was on the Conan O'Brien show years ago talking about how that experience has changed how he looks at the world. I'll tell you what he says here is Conan says, you must think about things differently being a former Marine. And he said, as a matter of fact, I'm sitting here in this studio and I'm thinking if the deal went down here, I'd look at the curtains back there because it's pretty good concealment. And then, Conan, I hate to tell you this, but I'd probably take you as a human shield. He said it funnier than I did, but that's the basic idea. He looks around and he sees combat situations, and I look around and I see financial situations. It's a little bit weird. I didn't expect that when I started into the business, but that is what's happened. So that's sort of the background about sort of how I'm thinking about the financialization of the world and the financialization of everything around us. But I think the thing that a lot of what's caused that, it's not just sort of viral ideas floating around. I think there's a lot of power in financial tools. The financial people understand, who've sort of educated themselves or been educated by their experience, understand that there are some fundamental tools that are very effective in terms of making decisions, certainly in their jobs, but to some extent those tools extend beyond their jobs. They can be used for other kinds of decisions. I'm going to talk a little bit about sort of some of the very basic ones and how they work. These tools I would describe as being, they're all words you've heard before. I'm not going to say anything that's in a different language or something you've never experienced before in terms of a conversation about decision making. But they're all things that are simultaneously diagnostic tools. You can use these as a lens to look at a situation and figure out whether there's something wrong or what might be wrong with something or where there's a missed opportunity. But they're also therapeutic tools. You can use these tools to make things right. You can basically figure out, how do I restructure a situation? How do I re-engineer a situation so whatever's not working right can start working right? All right, I'm going to talk about 4 tools. Tool number 1, math. Math is good. It's very helpful to have a good grasp of math when you're solving financial problems. It's pretty hard to get involved in finance other than just very conceptually at a very high level without being somewhat conversant and comfortable with math. Math is what we use for counting, it's what we use for measuring. You need to know how to manipulate mathematical concepts. Okay, tool number 2 is money. Money, also good for multiple reasons. Obviously, it's good for spending, it's good for functioning the economy, but from an economist standpoint or from a financial analyst standpoint, money has historically been described as having 3 uses. It's a medium of exchange, it's how you buy and sell stuff, it's a store of value, you can keep whatever you own in the form of money. You don't need to keep it in barrels of oil or livestock or storehouses of other commodities, of timber, anything else. You can keep it in the form of money, which is more convenient. For the standpoint of decision making, the third one is really the money shot here. It's the unit of account. It's how you measure things. It's how you assign the value to things, and it's how you figure out whether the units, the value that's associated with one opportunity or one asset is going well or going poorly. And that's really that's where the math and the money really come together, is in sort of using money as a unit of account. In some sense, it's a way we talk about value. Value is a very nebulous concept, but it's not entirely true that everything has its price, but pretty much everything has its price. Okay, so this is how I usually explain this to the people that work with me. If I have a young analyst or if I have an intern, I will tell them that this is their job. Bring me 2 numbers, and I shall tell you which number is bigger. That's the goal of finance. It's reduce it to numbers. Tell me which number is bigger. More is typically more, unless it's risk. You don't want more risk. You want more return. But that's when financial analysis is working and clicking on all cylinders. It's that easy. All right, tool number 3, and this is actually the original topic for this talk, and after talking to Neil a bit, I realized that this is probably part of the talk as opposed to the centerpiece. But debt and equity are very important in terms of thinking about opportunities, decisions, valuation. And there are a lot of ways to define it. An accountant might define it one way, a lawyer might define it another way. I think a good way to think about debt and equity is that both are contracts for exchanging money now for money later. If you're an investor and you're giving somebody money, they're going to give you money later. If it's debt, they're going to give you a specified amount of money at a specified time in general. And if it's equity, they're going to give you an unspecified amount, but it's going to represent some portion of some profit, of some gain or loss. So they're both contracts. They can be short-term, they can be long-term. Equity is typically perpetual, although it can get unwound, it can get sold. But when it's written, it's a perpetual commitment. And very importantly, I just described in very high-level terms how each of them work, but all of these contracts are negotiable. And 2 parties getting involved in a debt arrangement or an equity arrangement can tweak things, can add features, whatever works for both sides and whatever's fair for both sides is fair game, whether it's technically debt or technically equity. Pros and cons of debt and equity, I'll be very quick about this. If you're an investor, I describe basically what the deal is. If you're an equity investor, you have unlimited upside. You're a participant in the company's fortunes. If the company makes a lot of money, you're going to get some percentage of that money. On the downside, if the company goes out of business and the equity is worthless, you've lost all your money. Debt is very different. You give somebody your money, they are promising to give you the money back, giving you some interest along the way typically. Your downside is potentially unlimited as well. You could lose all your money. There are usually better protections on debt than there are on equity. You'll have some ability to seize collateral, to foreclose on an asset, to be the first in line for money when a company liquidates. So those are all benefits of protecting your downside if you're a creditor, if you're somebody who's lending money. Now these are, and one important thing to know about this is all a zero-sum game. You're not actually, when you're making these negotiations, you're not necessarily changing the operation of the business in any way. You're basically talking about how you're splitting up the money. And the debtors, or the lenders and the equity investors are just figuring out how to split up the pie. Okay, from the capital raiser standpoint, equity's very flexible. You're basically bringing in somebody in as a partner. There can be a huge opportunity to cost to that if the business does really well. If the business goes to the moon and you've given somebody half the business, you'll probably regret that if you could have just borrowed some money instead as a source of cash. But borrowing money entails losing some flexibility if cash gets tight. What do you do then? Debt can be a nasty trap, as we all know, for different reasons, both personally and from a business standpoint. Debt and equity have many forms. Here's just sort of a laundry list of forms of debt and equity. Debt can be a bond, it could be a mortgage, it could be a margin loan against a stock, it could be other kinds of personal liability, it could be a contract where you're on the hook for payments. It can be debt-like, it's an obligation to make a payment regularly. So there's a lot of forms of debt. Equity is a little bit more generic, but there are different features of that too. It's basically ownership. So one form of that is buying stocks. One of that is buying private equity, which isn't necessarily a publicly listed stock that you can buy from a broker. There are other things that are like equity in that they participate in the good fortune or bad fortune of a company. You might have an employment agreement that pays you a bonus that's a percentage of the profits of the company, and that's very debt-like. It's very equity-like. So that's the difference. Equity is going to have more upside. It's going to be riskier on the downside. Debt's going to be less risky, but it's going to have less upside. That's the trade-off. And again, I think now we've talked about sort of what debt and equity are, the really important thing to keep in mind is that there are things that are debt-like and equity-like. You hear people on bond trading floors and in bond portfolio management groups talking about how a particular debt investment has equity-like returns. And that means it may still be debt. It may be a loan that has a defined maturity and that pays an interest rate, but it may have a very high interest rate. And so that interest rate may be high enough that, all right, if I'm normally an equity investor and I'm expecting to get 10 or maybe 15% in the long run by investing in equities, maybe I can make a loan that has that potential as well. It will also potentially have more downside. Debt can have risk of losing money just as equity can, especially if it's already defaulted debt, which is another form of debt, which is it's still considered debt, although it no longer has necessarily a defined maturity date or defined interest payments because the defaulted entity can't pay any interest. Right, so just to kind of hammer it home one more time, there's sort of a debt-like to equity-like spectrum, and there are a lot of different kinds of investments. On the equity end of the spectrum, it's higher returns, higher risk. On the lower, on the debt side of the spectrum, there are more protections and typically lower returns. So in the far left, you've got cash, you've got US government bonds, you've got investment grade bonds. In the middle, you've got sort of distressed bonds that become more equity-like, that have more risk, more downside, but may offer a potentially higher return. And then on the far right-hand side, you have the equity-like characteristics of stocks and in some cases, derivatives on stocks that can give you very, very skewed upside in terms of the performance if the equity does well. Okay, tool number 4. We've just been in debt and equity for a few pages. Tool number 4, and this is the last of the 4 tools, is scenario analysis. And I love this thing. I don't think people talk about it enough, but I really love this little thing called the T account. Now, a T account, if you've taken accounting, is really just a very simplified version of a balance sheet. Okay, this is telling you where your money came from and what it's invested in. And the nice thing about a T account is you can do it on the back of an envelope. You can look at, all right, I don't need to know every single line item of my assets. I don't need to know every single thing that I own. I don't need to do the font right. I don't need to put the spacing correctly, the indentations on the asset side of the balance sheet the way an accountant or auditor would. I just want to say roughly, what do I own? And then on the liability side, what do I owe? What do I own? What do I owe? And whatever's left, assets minus liabilities, that is, for an individual, that's their net worth, and for a company, that's the shareholder's equity. If you can use this basic tool for modeling things up, it can reveal a lot of the potential upside and downside of whatever the investment or deal that you're considering is offering you. So just to sort of bring it home in terms of the simplicity of a T account for a common situation, let's say you're a generic household, you own a house, you have some savings, you have some stuff, you have cars, you have your wedding china that you got in the basement. And then the liability side, you've got a mortgage, you got a house mortgage because you own a house, and then everything left, if you take the value of all those assets and subtract the value of the mortgage, is your net worth. So that's how it works in a very, very simple case. So let's talk about scenario analysis, how to use a T account like that to do scenario analysis. And again, I would keep this approach really simple when you're starting to use these tools, these building blocks for decision making. You've got a T account on the left, you got a house, again, you got a home, you got savings, you got stuff, you got a mortgage. And I put some numbers on it this time. Look at 3 different scenarios. Look at what if everything goes well, housing prices go up, your investments are going up, and the mortgage isn't doing anything. You're just paying your mortgage as you go along. Then look at a neutral case. What if nothing changes? You may be making some payments on your mortgage. You may have some income on your investments, or you may have some income from your job. If that's more or less self-financing, if the amount you're getting in the door is covering all of your costs in terms of interest and expenses, you'll be more or less flat, kind of unchanged in sort of the neutral scenario. Now, how about the bad scenario? All right, your home has gone down $50,000. And again, the sort of benchmark here, the reference point here is the basic net worth at the beginning of this is $200,000. The home goes down $50,000. The savings go down $50,000. The mortgage actually goes down a little bit because the mortgage can be sensitive to the price of the house. All mortgages are different. Some mortgages are guaranteed. The government's guaranteeing the credit risk of the mortgage, and in that case, you wouldn't lose anything. The mortgage would not go down at all. But if it's a mortgage that's purely secured by your home and the price of the home goes down, that mortgage is going to be worth less. In this case, you've lost $100,000 between your home going down and your savings going down. Your mortgage going down $5,000 has an interesting effect. It doesn't reduce your net worth. It actually increases your net worth technically because you now have smaller liabilities than you did before. So it's a little bit, this sort of unguaranteed mortgage that's purely backed by the house that you bought has kind of a hedge effect on your net worth. You're getting $5,000 back by the decreasing value of the mortgage and the fact that your assets minus liabilities are off a little bit better than they would be. They're a little bit better off than they would be if the mortgage had not gone down $5,000. Now, that little tidbit where you have something on the liability side of your personal balance sheet that kind of hedges the value of your overall financial circumstances is something that innovators, some of the fintech companies out there, have sort of seized on as a business opportunity. So I'm going to show you one more version of this scenario. It's a little bit more complicated, but it's basically the same thing. Instead of having just a home, savings stuff, and a mortgage, there are a couple companies out there, and I'm not advertising for them because I think they have their pros and cons as well. But there are a couple companies out there, HomeTap and Point are 2 of them, that will allow you to sell a share of the equity in your home. Right? So you basically say, okay, instead of having 100% investment in my home, I'm going to sell HomeTap 20% of the value of my home, and they'll give me some money for that today. It's like you've created a company out of your home and you've sold shares of stock. You're selling 20% of the shares of stock in your home to this third-party company that's doing that. And as you can see here, there are effects on both the good and the bad side. On the good side, you aren't profiting as much as you would have from the appreciation of your home because you've given 20% of it to one of these equity share companies. So instead of your net worth going up 100,000, it's only gone up 90,000. Okay, in the bad scenario, the home's gone down 50,000, the savings has gone to 50,000, the mortgage has gone down 50,000 again, same thing. The mortgage is collateralized by the home, so it's worth a little bit less. And then the equity share has also gone down $10,000. So you've gotten $15,000 back from the loss of value in the mortgage to somebody else and the loss of value of the equity share to somebody else. You don't effectively owe them as much as you owed them before. Now, it doesn't fully offset your losses because you still own those assets, your savings in your home. But there is a hedge effect there, and that's appealing to some folks who don't want to take out more debt. They don't want to take out a home equity loan. They feel like their home is worth quite a lot, and they don't mind taking a little bit of the value of their home off the table. They'll sell it to somebody else. So the point here, really, I hope this is fairly clear. No pun intended with the company name point. But the point here is that this quick back-of-the-envelope analysis is sort of the genesis of a particular product that has a market. And innovators are going to look at this and say, there's something we can do with the fact that it's beneficial to homeowners to be able to sell something to somebody else to reduce their risk on a particular investment that otherwise is very hard to do in a fractional way. You kind of either sell your house or you keep it. In this case, you're selling a little bit of your house, and that can be appealing to some people. The deals these guys do, I've seen, and they don't look very attractive. I don't think they price them very efficiently, but the concept, I think, is pretty interesting. And it's sort of a hint to how financial innovation happens out there. Okay, let's go to a really simple, at this point, I'm just kind of talking about how we sort of tinker with financial products, and we tinker with debt and equity to sort of find interesting situations and find opportunities in the market, and how you can look at your own situations. So there's a concept called asset liability matching, where you basically match up your assets with liabilities that have very similar characteristics. This is the way to have a very safe set it and forget it balance sheet for yourself. You got short-term loans. If you're a bank, short-term loans, you finance those by taking in deposits to people, short-term liabilities, short-term assets, and you can make longer-term loans, and then you probably want to finance those with longer-term debt. So basically, the cash that comes in is more or less matched to the cash that goes out the other side, and if there's a little bit of a spread between what comes in and goes out, you're adding to your shareholders' equity over time. So this is a very conservative approach, and it's a very sensible approach for people who don't want to get too aggressive with their investments or their financial situation. And I actually use this approach with my sister-in-law, who was at retirement age and whose husband had just died. And we sat down and talked about, all right, what are your short-term assets? What's coming in the door? Are you going to be getting paychecks from your work? You're not retiring yet, and do you have available cash that's throwing off some interest? And then on the liability side, what are your expenses going to be in the near term over the next 5 years? And importantly here, I'm doing two things. I'm doing the asset liability management like I talked about in the previous one, but I'm also adding in another set of assets and liabilities, which is your job. It's important, I think, also as you do this analysis for your personal balance sheet to look at your job and think about, all right, where are the risks and how well are my job commitments to my employer and my paychecks from my employer, how well are they offsetting my other expenses and revenue and my other assets and liabilities. And that changes over time. You've got, as you're at a given age, you've got, what are you thinking about for the next 5 years? Are you setting yourself up for the next 10 to 15 years after that? Are you still going to be working? Do you have sufficient money to pay off all of your expenses? Are you still going to be committing your time to your job? Are you going to be retired? It's hard to say. And then long term is basically retirement. Are you going to have enough money in the bank and have enough investments that are going to offset your expenses as you're in your later years? All that is effectively the same thing that banks do in terms of asset liability matching the term of your assets with the term of your liabilities and trying to offset them. But it is taking into account yourself as both an asset and liability. The time you're committing as a liability to your owner, to your employer, and then the revenue that you're earning from your employment. Okay, let's whip through a couple more of these. Another thing that we sort of tinker with in many cases, we've been looking at basically individuals and companies up till now. You can take any one or any sort of subset of these assets and liabilities, this debt and this equity, and look at them on a T account as a separate strategy. Just lift it out of the balance sheet and just think about this as an isolated thing. How does this transaction, how does this investment strategy work? I've got a few examples of these. One is a carry trade, which is sort of like the bank idea. You've got an asset that throws off interest. You're borrowing money to pay for that asset, and you're hoping that the interest that you earn on the asset exceeds the interest that you're paying on the liability. There may be other features of that kind of trade that would make the value go up or down. A lot of carry trades are currency carry trades, so your liabilities might be in yen and your assets might be in dollars. That's a whole different level of risk. That's not something we probably typically do as individuals, but that's also considered a carry trade because you're arbitraging the difference between interest on dollars versus interest on the yen. This is the second one here. A lot of people are mystified by short sales of stock, and a short sale of stock is really just making the price of a stock a liability on your own personal balance sheet. You don't owe money to anybody when you sell a stock short. You owe shares of stock to somebody. You've got to deliver those stock at some point later in time, and in order to do that, you've got to buy those shares in the market to deliver them. And the difference between where you sold it earlier on and what you paid when you bought it back is your profit or your loss on the short sale of a stock. So a short is a liability, and a short, especially to financial people, is kind of the same thing. I owe this to somebody. If it goes down in price, I'm better off, and hopefully I'll have assets that will offset whatever I owe on that liability. And then lastly, one other sort of kind of trade, which is interesting to think about. I'm not encouraging you to focus on the derivatives market in a great deal, in any sort of intensive way. I grew up kind of in the derivatives market. Those were my first jobs on Wall Street. And all these sort of terms you hear in the derivatives world, whether it's futures contracts or interest rate swaps, you can kind of reconstitute those contracts as a combination of assets and liabilities. For example, a stock futures contract is like a portfolio of stocks that's financed with overnight money. Basically, you borrow money overnight, you buy a bunch of stock. The next day, the futures exchange will either give you your profit back and keep your position in place, or make you pony up your loss for that transaction in order to pay for the fact that your stock doesn't cover the loan that you took out. Now, it's not literally a loan and literally buying a stock. The futures contract is just a contract that represents that relationship. So again, it's kind of building blocks of assets and liabilities to create other instruments. A little bit further here. Okay, another source of innovation here, thinking about this, taking a particular investment strategy out of a portfolio, and for a particular reason. A lot of assets are interesting to companies or interesting to investors, not because they offer a particularly high return, but because it's very cheap to finance them. Lenders will lend you money collateralized by an asset at a very low interest rate. And an example of companies using that very actively are a lot of the big real estate companies will separate their operations into the operating company, which sets the strategy for the company. It does the advertising, it pays people, it has the sales force, it runs all that stuff. And then another company, which is the property company, which is basically the company that owns the real estate itself and taps the real estate investment market to finance that, because those investors are comfortable financing those assets. They don't want to get involved in the rest of the operations of the company, but they like lending money to real estate, and they'll do it at a reasonable rate. So that model of having the operations in one entity and the property in another entity is called the OpCo-PropCo model. And that's been around for years. The auto companies have used it when they've had an auto loan capability, when they finance their cars. Again, the real estate companies do that very often in the hospitality business or in the commercial real estate business. So taking those cheap to finance assets out and getting other investors to come in and finance them cheaply can be a way to improve the economics of your combined business. Another version of doing pretty much the same thing is, instead of selling these assets or financing specific assets with a particular investor, is to package those assets up, whether it's real estate, whether it's car loans, whether it's credit card loans, give them to an investment banker and say, sell these to the market as a portfolio of bonds. You're going to have bonds that are backed by these car loans, and I will have sold the assets, and I will then have sold, and then investors will have bonds that are backed by these assets, but are earning a rate of return that's relatively low because they're high quality assets that investors are comfortable with. So it's another way of capturing and sort of isolating the market for one particular set of investments by pulling them out of the main company and taking advantage of your ability to finance them. Okay, lastly here, in terms of innovation, or second to lastly, there's this concept that sort of emerged over the past 10 or 15 years of assets as a service, where basically a tech company has an idea about how it could run a taxi business better, or how it could run a hotel business better than sort of the legacy folks in that market. And the two poster children for this are Uber in the taxi business, Airbnb in the hospitality business. And in both those cases, the propco for those businesses is, for Uber, it's drivers. Drivers are financing their vehicles for them, which is a nice deal. Uber has the biggest taxi service in the world, but it doesn't have a balance sheet full of taxi cabs. All the cars are owned by the drivers. And then Airbnb, similar thing. It's a big hotel company, effectively, and it manages all the operations, manages the technology, and the people that own the property for them are all the individuals who have vacation homes that they can rent out and then pass off the profits to Airbnb. So this is a terrific model that's worked very effectively in a lot of different businesses. I think the inspiration for this is kind of like Tom Sawyer coming along and saying, I'm gonna give you the privilege of painting this fence for me, and I'm gonna have the fun of sitting and eating a piece of watermelon while you guys are painting it. Uber is kicking back and earning the high profits on a tech business, whereas the property owners are sort of getting modest returns on driving the Uber vehicles. Okay, I'm going to show you one more quick video. We haven't talked a lot about hybrids, but in that spectrum I showed you before between debt and equity, there was sort of a middle section which was kind of like debt and kind of like equity. And one of the most familiar versions of that that probably people know, if you're watching, if you're a viewer of Shark Tank, Kevin O'Leary, Mr. Wonderful, will almost always come in with an offer that involves a royalty. And here's a clip of him doing that, and just listen to what he's describing in terms of the transaction. Oh yeah, great, thank you. You got the mic.
Around. But Kevin is interested in Trevor and John's innovative broom company, The Broom.
Here's an offer for you. I'm known for being creative with my offers. I teach the sharks how to structure things. So, $350,000. I give you that. Because you brought up the word royalty. I didn't. You did. I like royalties because that's how I can get my capital back. So I'll give you the $350,000. I want a $3 royalty on the Vabroom until I recoup $700,000. So I'm not being greedy about this, okay? I just want some return of capital. But I want 2.5% of the design firm because I don't know what else is coming down the pipe. All right?
Okay. So I don't know if you caught all that, but basically the royalty, he's going to get twice his money back in the royalty. He's going to get the money paid to him up front as the product gets sold. So it's kind of like debt. It's kind of like debt, but it's really, really high yielding debt, and it is participating on the upside because he's going to get double his money back if they can get all $700,000 paid back based on the royalties that accrue. And on top of that, I mean, I don't know what the other offers were for the equity in this company. He's basically both buying a revenue stream from the sales of this product, and he's making an investment in the company. I'm guessing that he's probably not making the most aggressive investment price on the equity in the company. And these guys are probably, they're stars in their eyes about getting $300,000 in without having to give up equity. They're not, the royalty doesn't dilute their equity per se. It does take a little bit off the top line in terms of what the revenues are, so that might kind of affect the equity, but it's not literally shares of stock in the company. So O'Leary's a pretty shrewd guy. That's the takeaway there. All right, so where are we? I gotta go back here. Yeah. No, I'm not gonna use the last video. Okay. Okay, go here. There we go. Oops. Okay. So one last slide here. So we're starting to talk a little bit about how doing this kind of financial tinkering, kind of moving debt and equity around and thinking about different way to solve different problems or have different effects is continuing to expand. I talked earlier on about Moneyball. That's not technically moving debt and equity around. It's not using balance sheets, but it is using the analytical techniques from the financial services market in sports. And that's clearly been happening forever, and the rest of the world is getting Moneyballed sort of by that same model. A couple of other instances which I think are kind of interesting, and these are personal instances for me. Several years ago, there was a Jeopardy champion named James Holzhauer who came in. I don't know if you watch Jeopardy, but he basically kind of shook the Jeopardy world by having a very aggressive strategy of betting on daily doubles and betting on Final Jeopardies. And it was, at that point, the all-time great Jeopardy champion was Ken Jennings, now the host of Jeopardy. And this is a quote that he made to Wired magazine. He said, "I'm just gobsmacked by James. I would never have had the stomach for those kinds of bets. You're going to have to be comfortable with losing the average American income on a single trivia question." So Ken is thinking, that what I was saying earlier about taking your job or taking your external experiences and putting them on your balance sheet, that's the way Ken was thinking about when he was putting. He was just trying to win. He wasn't trying to make a lot of money. It actually, if you break it down and look at what's the optimal strategy if you're trying to win, Ken has the optimal strategy. He's taking less risk, and he's less likely to lose a match. And he won like 72 games in a row. Holzhauer did not last as long, but he had some giant wins. He made more money than anybody ever seen on a Jeopardy competition. So it's sort of two different objectives and two different sets of preferences that affected these two guys' strategies. So I wrote a piece for the Boston Globe about this a few years ago. You probably don't have a login to Boston Globe, but if you're interested, just reach out to me and I'll send you a PDF version of it if you want to learn more about that. And then lastly, one more thing. One place you would never think about financial thinking infiltrating is charity. Well, there's an organization called GiveWell, which I was involved with for many years. I was chair of their board from probably a year after they launched till for about 12 years. And the founders of GiveWell are two hedge fund managers from Bridgewater Associates, which is the biggest hedge fund in the world. And they basically said, we don't understand why people are not trying to figure out how to get the most return for their charitable dollar. We want to figure out who's the most effective charities out there. And that's a hard question to answer because it's sort of a lot of apples and oranges questions. But who is the most effective on this? How do we do deep analysis on that, make the case that they're very effective, and then let our donors know about that and see if they'll invest? Well, GiveWell has been a phenomenal success. They were just a couple guys, young guys really, just a few years out of college, left Bridgewater, launched GiveWell, and they're now moving about $300 million a year to their top charities because they're picking such good charities. It's not the way a lot of us do charity. A lot of people are focused on local charities. They're focused on particular affinities that you have with your school or whatever. These guys don't have preferences like that. They're just trying to figure out who is having kind of a remarkable effect on a major cause. And they've done an incredible job. And I think financial thinking, that's an area where financial thinking, I think, has been actually beneficial and has saved a lot of lives. So I went on a little long, and I apologize for that. But that's it, and I'm happy to open it up to questions.